Hello, everyone, and welcome. My name is Sean Adams. I am the president and founder here at Leverage Life Management. Wanted to thank you for taking time to check out this recording webinar and learn a little bit more about our leverage wealth accounts. So for starters, just for some quick background on myself, I spent the beginning part of my career owning multiple different small businesses and actually transitioned into a software sales executive as well in the software space. And one of the main themes that I found both in my entrepreneurial requests as well as a high paid sales professional is just a general struggle with where to put earnings, where to put my money. Looking at retirement accounts like qualified 401ks, IRAs, investing in the stock market, all of these things were very problematic for me. They either had restrictions that didn't fall in line with what I needed, or I just didn't have this good access with my savings and what I could use it for. And I really wanted to learn more about what wealthy people and what corporations and banks were using and how they were using their money to really make more money, to sort of pioneer these concepts of wealth. And so I went on a very big quest to learn more about this over the past couple of years. And I found one strategy that has been monumental in my own life, as well as many of our clients as well. This concept moves around what we call the 5 levers of wealth. And essentially, these are the 5 sort of characteristics that we look for in a savings vehicle, where to put our money so that we have some of these advantages. And those 5 levers are guaranteed growth. So whenever possible, we want to try to have something that has a guarantee to it. If we look at the 401ks, the stock market, all these sort of things, they have returns that have, on average, reached a good level of rate of return, but they have not been guaranteed in any way. We've also got these tax advantages that we like to try to take into account when we're putting our savings in place. We also want to make sure things aren't 100% correlated to the market, right? If the economy goes down, we have one of these down couple of years, we don't want our nest egg, our retirement, or any of our savings to be affected by what things are outside of our control. Liquidity is also a major thing. This was big for me as well, is where I did not want to have no access to my lump sum of money that I was putting away. I was working hard for my earnings. If I wanted to invest in something, I didn't want to have to wait till I was 59 and a half or have to follow some sort of guidelines just to access my own money. And lastly, I wanted some level of protection. Apart from the guaranteed growth, I'd also, want to make sure that I had something for my family that they could access and utilize and then have to be hit with penalties and any sort of planning that have to happen there, right? So protection is a big part of this. The strategy that we use actually leverages cash value life insurance, believe it or not, and protection is a monumental piece of that. There's actually an associated death benefit so that your beneficiaries, your spouse, your partner, your family will have this nest egg protected and they can have access to it as well. So the main principle that I started to really do my research on and found was a common thread among the ultra wealthy and the corporations was this idea of a banking principle. And what that meant was the wealthy were viewing their organizations, their families, their corporations as banks. And they wanted to take these banking principles into action. And one of the things that they've really pioneered is this concept of using other people's money to grow their money, to make profits. And if you actually look at banks that are publicly traded, the Bank of Americas, the JP Morgan Chase, any of these large banks that are on the stock market, if you look at their balance sheets, you'll notice that one of the biggest assets that they have, what they call tier 1 assets or tier 1 capital, is invested into high cash value life insurance. And it's going to be for all the reasons that we're going to talk about here today. And our principle, the whole reason that we have this recording and why we founded this business is to bring those concepts to light for the average high income earner, for the average sales professional, the average entrepreneur out there. These principles are something that are available to you guys, but have not been advertised and made accessible to the average person. And that's what our mission is to do. So let's first break down actually how banks make their money. If you've seen some of our other videos, you may have seen how this concept is played out. We're going to go through a really quick example visual here so you can get an idea. So you are an account holder at your local bank. You have your hard-earned income that you're bringing in on a commission check or your salary. You go and you deposit that money into your account. Well, what does the bank actually do with that money? How are they making money? Obviously, they make loans, they have fees on accounts, they have little percentages here and there, but that's only a portion of where they make their money. Where they really actually draw their profits and how they've made billions and billions of dollars for more than a century is through this concept of using life insurance. So what they do is they actually take your money, a portion of that pooled with other people, other account holders at the bank. They put all of this money into what is called a cash value life insurance policy. So all that pooled money is basically an asset like anything else, and that asset can then be insured, and you can actually have all the benefits of that insurance policy. So think of the policy like an account. They take your savings and they put it into a different savings account. That insurance company will actually guarantee a rate of return at a minimum of 4% and up to about 6.5%, 7% on some policies. And they will actually return that premium or that interest to the bank each and every year that they have the money in that insurance policy. So the insurance company says, okay, if you're going to store your money with us, we will pay you a minimum of 4% back to the bank. So the bank doesn't even have, skin in the game in terms of your money. They are taking that, pulling that money, putting it in insurance policies, and reaping the benefits of that. Now, they invest a lot of their own money in these things as well, but they use your money to make them lots of money. And what do they do in return? They give you abysmal rates of return on your savings accounts, 0.1%, teeny tiny fractions of a rate of return that does really nothing for you at all as an account holder. They give you this sort of mirage of you can use a checking account and you get all these advantages and services of the bank, which sure, those are all very useful. But in terms of long-term savings and us looking at our life and our investments, we're not going to be able to make enough money off of the tiny little rates that are sitting inside of a bank. So our concept, our strategy eliminates the bank from the equation for our long-term savings. Now, I just want to clarify here. We are not saying that you need to take all your money out of the bank, store it in your mattress, put it in the walls. We are saying that we're talking about long-term savings here, not your checking, not your day-to-day banking and finance needs. Of course, keep all that stuff going. It's about not having to stick your hard-earned lump sums into an account that basically is being eaten away by inflation because you're not getting any growth on your money. So our strategy eliminates the middleman, being the bank in this equation, and connects you with that insurance company and take advantage of that same progress that the insurance companies have been doing for well over 100 years. So you can earn that 4% floor. You can gain all those benefits and advantages that you would get out of one of these policies. So it's important to note, and I'll stop here and mention this, we are not tax consultants. We are not financial advisors. We are simply insurance brokers who set up these policies in a very structured way so that we can help you warehouse your wealth. So it's important to note, if you are going to make any sort of financial decisions, that you consult with your tax or your finance professional in that capacity. But what we're talking about here is a place to keep your money. Your cash has to live somewhere. Let's put it into this warehouse, metaphorical warehouse, where you can gain and reap the benefits of guaranteed interest, tax advantages, as well as leveraging the liquidity of those accounts. And you can use it for your retirement. You could use it for other investments, right? We're not talking about giving your money to the insurance company and that being your end all be all in terms of an investment. We're talking about using that and then leveraging the money in there to make more returns. So maybe you make 4% at the insurance company and you can make 9% somewhere else. There's ways that you can structure all this, but it all starts with putting all of your hard-earned lump sums into a warehouse that we can then deploy into whatever else we might want. So let's talk about actually how this structure works. So our leveraged wealth accounts are specifically designed to allow you to purchase these cash value whole life insurance policies, just like the banks do. If you're familiar with any sort of whole life insurance, you'll notice that there is a component of death benefit, which is essentially just a nominal amount of money, a lump sum that your beneficiaries will get when you die. So an easy way to think about this is if you were a 30-year-old and you're making $100,000 a year, you're going to work for 30 years, you have sort of a contribution to your family of, let's say, $3 million, 30 years at $100,000 a year. Let's take inflation out of the equation for a second. So that means that you're going to make $3 million over the course of your working years. And so if you were to die early or something were to happen to you, get disabled or something else, a crisis comes up that you cannot perform or actually contribute that $3 million that you normally would, you can actually insure yourself and insure that value that you bring to your family. So there's a lot of other components that go into that, but the death benefit is essentially there as a safety net. When you die, your beneficiaries get that. Whether that is something sudden that happens, or you get to the end of your life and you die naturally, your heirs, your spouse, your family, your beneficiaries will get that death benefit. That is that one component and pretty straightforward of life insurance. Whole life insurance also has this capacity of cash value. And we'll talk about an example here that I think should kind of help clarify this. But cash value is essentially the equity that you build in, right? So as you put money into this policy, it's going to go towards two things. One, you can put money towards the premium that buys you that death benefit and the safety net of an insurance policy. And it also, you can have your money go into cash value, which is just the accumulation of your cash inside this policy. Think of it just like a savings account. Our goal is to maximize the cash value inside one of these accounts. So you can think of your cash value as sort of like your living benefit. If the death benefit is when you pass away, the living benefit is your ability to use the cash value that accumulates in these accounts during your living life. Now, we do all this in a way that we actually can structure to overfund these policies to focus on the cash value. Death benefit stays intact. It's still there. It still gives you all the protection. But we want to really over leverage ourselves on that cash value because that's where all the promises, that's where all this policy can really start to work for you. So we mentioned this before. If you have a policy and you have money that you contribute to an insurance policy, it can either go to one of two things, to expenses, right, which is the premium. Just like you pay your auto insurance, you pay a monthly or an annual bill to have that coverage, to have that insurance. That's what your premium covers. It buys you that death benefit and these other benefits we're going to talk about. Or you can have your money go into what's called paid up additions. This is essentially cash value. It's just a insurance term for when you put more money into that account and you overfund it, it goes in terms of this paid up additions or PUAs, and that builds your cash value. We really want to focus on that PUA or that cash value component. So what does cash value actually do for us? Well, we talked about those 5 growth levers, right? We want guaranteed growth. Our insurance companies actually guarantee an interest rate of that 4% as a floor, just like the banks do when they purchase these things. We also want tax advantages. So of that 4% compounding growth that we're getting year over year on our money, we also want to make sure that we're deferring that or having some sort of, it's not taxable, right? So the gains on that technically are taxable, but that's only if we withdraw that money, right? So this is going to be similar to how you may think about things in your 401k, except there aren't going to be the level of restrictions you have about age, about minimum distributions, and all these restrictions and guidelines you have to stay within. We talked about the non-correlated piece. Our companies that we work with are mutual insurance firms. So that means that they're owned by the policyholders. They're not on Wall Street. They're not stock invested insurance companies. So this means that their value does not fluctuate with what's going on in the economy. Their value goes back to the policyholders, which are you and I. Liquidity was actually the other big piece, right? Our cash value is that liquid amount we have in our account that we funded. It's available to us to be loaned out against anytime we need without penalty. So you can loan out against your 401k, your other retirement plans. There's all sorts of restrictions. You pay a percentage of penalty. You can only do a certain amount. It's very challenging and it's very, they fight you the entire way. So with our accounts, liquidity meaning you have access to that money the entire time you are a policyholder. The original principle, in which we'll tie into a little deeper here, is never affected as the money is used. What that means is basically you can use your money in two places at once. We'll go through some real world examples so you can see what that looks like. And lastly, we talked about protection, right? We want to make sure at the end of the day, we are purchasing something that's going to actually cover us. We want that blanket over our asset, which is this account that we're building. And we want to make sure our family and ourselves are protected in the meantime. Also, most states will allow these insurance policies to be protected from things like bankruptcy, divorces, or even creditors too. So if there's ever like a lawsuit or anything that happens, this is actually a contract between you and the insurance company. It's a private contract, which means it's not disclosed on your credit report or anything like that. So you're protected should anything happen. You have that layer of protection over you. So we talked about those two places your money could go. You might be thinking to yourself, well, can I just put all my money into cash value? I don't really care about the death benefit, right? My family can get whatever's left, but I want to really enhance the living benefit. Can I just put everything into cash value? Well, again, going back to this concept that we are purchasing an asset, that real asset has a cost to purchase and a cost to get all these advantages that we get out of it. So let's go through an example so you can actually see what this looks like. So the analogy that I like to use is think of your account, the savings asset, as a property or a home that you're going to purchase. When you buy a home, you've got the expense component, right? You have to actually purchase the property. Down payment, you also have a mortgage or a loan that you pay back to the bank each and every month, which basically allows you to afford to live in the home, right? That expense, that mortgage, is the exact same thing as a premium in insurance. We have this asset, this death benefit that we've purchased, and all these living benefits that we purchased. We're paying a monthly premium to the insurance company to get all of these things. That's the cost component. But just like a regular asset like a home, we also have things that help grow that asset, right? Assets add to our column, add to our net worth, where liabilities take away from that. This asset, like a home, is going to have natural appreciation. Right? If I buy a home in 1990 and I fast forward to 2020, I've got 30 years of appreciation on that, maybe 1 or 2% growth each and every year, if not more. So that asset is inherently worth more as more time passes. In real estate, that's called appreciation. In terms of insurance, these policies are growing through interest. So each year, the interest gets put onto that money, that lump sum, and it grows or appreciates based on that interest that's being paid out. All that interest, all that cash that's going into that asset is gaining equity, right? And so that is the core component here. So if we are on a property that we have for $200,000 and we paid $100,000 into it in the first 10 years, we have equity built in. We have $100,000 of equity built in. Same concept with your insurance policy. If you're paying into that policy, you're going to be gaining cash value, which is equity. Anytime you have equity in something, you're able to leverage that equity and use it in different ways. Also, when you have an asset, you also can increase the value of that asset in a number of ways. So in real estate terms, you can put a renovation on the property, you can add an addition, you can put a new roof on, you can do curb appeal. These are just little tools and techniques that help you to craft or make that asset more valuable or allow you to leverage it in different ways. There's creative tools you can use. If you know any creative real estate professionals, you'll notice that they have all sorts of tricks for what to work on, what things to fix on a property, how to leverage a loan, how to borrow money, how to refinance. They have all kinds of strategies and techniques to make that asset that they purchase as valuable as possible. We have all those same things in the insurance capacity, and that's what our team specializes in, is what we call policy design. So this asset is something that we're experts in putting together the right tools to make this asset as valuable and advantageous as possible. So instead of additions and using all those sort of things that you would use in real estate, our asset, we're able to use things like what we call riders. These are just little terms on the contract and things we can put in place that allow the policy to be worth more and to let it do what we want it to be able to do. There's also provisions and some exclusions and inclusions we can do and all kinds of ratios. We won't get really tied up in the details here, but just know we have a lot of tools at our disposal in the insurance realm, and our team is going to assemble those onto your policy so you can get the most benefit out of it, depending on what you need to do. So going back to our goal, we want to maximize our cash value inside of a life insurance policy. So the ways that we do that is there is a very specific rider called a paid up additions rider. And that is like the fundamental core of how our leveraged wealth accounts work. This is how we're able to flood these accounts with cash and grow that cash value so we can utilize it like a bank account, like a savings account. So remember, you can contribute to either the premium or the expense or the cash value, and you get to choose where your dollars go. So you always have to keep some level of premium in there. Now, with the premiums, this is not something that you're going to pay forever, right? A lot of traditional whole life policies will be in place for your entire life. You're paying that expense year after year after year. With our policies and the structure design that we put in place, you only have to pay that premium for a set number of years in the beginning. It's typically about 2 to 5 years, depending on your age, your health rating, and the amount of money we're talking about. So there's some factors that go into play there. But essentially, we're going to try to squeeze down that premium as small as possible for you and maximize what you're allowed to put in to the PUA, the paid up addition, or the cash that you can flood into the account. So with the insurers that we put out there that we partner with, the lowest ratio between premium and cash value, or PUAs, is what we call a 10/90 split. Again, don't get bogged down in the terminology. Just know the kind of the rough concept here. What that means is we can squeeze that policy down so we are just paying 10% into the premium, and the remaining 90% can go right into the cash value accumulation into our account, the savings component. This is the lowest amount that insurance companies will let us do. And if you have any kind of life insurance, this might come as a shock because a lot of companies think that this is not possible to do. We've done this many, many times. This is what the ultra wealthy and banks have been doing for well over a century. And this is what we're going to make available to you. So continuing that concept, the way that we do this is we sit down and have a conversation with you, and we identify what the maximum ceiling is that you would want to pay into your policy. What's the maximum savings in 1 year, in a year, the annual period that you'd like to put into a policy? Now, not what you want to be required to put in, it's what you would like to, in an ideal scenario, be able to put in here. And what that gives us is our maximum, and that's the 90% component. And what we're able to do then is set up the premium based on that. So basically, the premium is going to be 10% of that maximum that we want to be able to put in. So maybe you make $150,000 a year and you say, Sean, look, I can put in $50,000 a year into a policy. That's the max I think I can fund. And if I have a really good year and I've got extra cash going in. So what we'll say then is, okay, $50,000 will be our ceiling or our maximum. Therefore, $5,000 will be our premium, the insurance cost, 10% of that total maximum, right? So that's what we're describing here. The premium will be 10% of that cash value, of what we can contribute to cash value in any given year. The example I have below, if you wanted to put, say, $6,000 a month, how you contribute to that cash value is completely up to you. If you want to do it in a quarterly, monthly, if you want to contribute nothing at all, 1 year, if you want to put it all in one big lump sum because you sold a property or you got a big commission check, you get full flexibility over this. Remember, that maximum, that ceiling, is not required. All you need to do to keep the plan, the policy in place, is pay the premium for those first few years before the policy actually starts paying for the premium itself. And again, that usually kicks in between this year 2 to 5, depends on the structure and your scenario. So that's how we really maximize this cash value. We say, okay, what is that maximum that you would ideally like to put in? Take 10% of that. That's the premium. That's the split the insurance company will let us do. And now you can flood that with as much cash as you would like. So which companies in particular allow us to do this? So you might be sitting here going, okay, well, I have a life insurance policy, or can I just go to any life insurance company and just allow them to let me do this? The answer is a resounding definitely not, right? There's many, many different whole life insurance companies out there. It's vital that you work with a company that puts one of these strategies in place and understands how these work. Now, you might have heard this concept being called things like infinite banking, privatized banking, bank on yourself. These are the ideas of putting that 10/90 split into a policy. It has to be designed in a very, very specific way. And only a certain set type of whole life insurance companies will actually allow you to do this. And so it's critical that you make sure you're working with one that allows for this. You definitely, if you have an insurance policy in place, you can 100% convert that typically over to one of these policies. We've helped companies do that or individuals do that. You can also, if you have something like term insurance, we have ways where you can kind of convert that or get rid of the term and get into a whole life policy. And so it's not going to be just going down to your insurance company, call them up and say, hey, I want to do this. They're probably going to tell you no. And that's because this strategy has to be set up in a hyper-specific way to be able to achieve that. So just for some reference points, we work with what's called the Big Four. These are just the 4 major mutual companies. We do work with a handful of other smaller companies that also allow us to put the leveraged wealth accounts into practice. But these are the main ones that really have pioneered this 10/90 split that we allow. Mass Mutual, Guardian, New York Life, and Northwestern Mutual. And so again, we do work with others, but these are the ones that we'll use in our examples on our website, and you'll see some illustrations on. If we meet together, we can talk through that. So when we say mutual, what that really means is it's a company that is not publicly traded, right? So they're not on the stock market. It means that they're owned by their policyholders, not stockholders. Well, that's really, really important because insurance companies, if their goal is to repay the stockholders, the profits, their direction is all going to be on how they can grow the stock, grow the net value of the company to return to those stockholders. Where with a mutual company, it's all about you and I, the policyholders. And so any profits, any advantages all go back to you and I, right? So if you own stock in IBM, a publicly traded company, and they decide to raise their customers' prices just so they can inflate the stock price, they can do that. And it has nothing to do with the customer, right? The customer is not in the best interest. It's really just about the stockholder who owns that piece. Mutual companies, it's all about the customer, who is you and I, who has these policies, and they have a responsibility to return any sort of premiums to us that are overpaid or that they have profits on. And so one of the ways they do that is insurance companies, in the first few years that you're being charged a premium, they actually overcharge you for that. And that is to protect themselves, to buy that death benefit and all the living benefits that we get out of these policies. But the beauty of this is it also allows the mutual companies to return to us, one, the interest, right? That's the floor, the 4%. That's guaranteed. So we always get year after year. And the overcharge, or the return of those overcharges, comes in the form of dividends. This is on top of the 4%. Now, this part is not guaranteed. So they do not have to return dividends to us, although the companies that we work with have consistently, year over year, returned a dividend to their policyholders for more than 100 years consecutively. So that's the type of companies we want to work with. They have a proven track record. We don't just pull off anybody, and it's for a very specific purpose. So those dividends might be 1% to 2%, depending on the company, depending on the year. And again, not guaranteed, but the companies we work with have always returned some sort of dividend every single year. So it is their responsibility, like I mentioned, to return those unused premiums in the form of dividends to us as the policyholders. So we talked about why do we want to flood our cash value life insurance with cash? Like, why do we want to grow that? We've talked about this before, but basically these policies give us all of those 5 levers that we touched on: the guaranteed growth, the tax advantages, the liquidity we're looking for, the non-correlation to the stock market, and the protection that we want out of insurance policies, right? So it touches on all of these levers, and in our opinion is the best place where you can take advantage of these 5 levers without having to have yourself overexposed or not having any sort of guarantees. Okay, so now we get the concept that we're putting money into this policy. We're getting the premium out of the way in the first couple of years. And now we're saying, okay, well, how do we utilize that cash value? I keep hearing you say that we can leverage the cash value. What does that mean? So thinking of this like a savings account, how do we use that money if we want to for different things? So back to our analogy of a house, you can think of the cash value, remember equity in the account, like a line of credit or a cash out refinance. And what that means is that cash value is our equity in our policy. Therefore, we can access it through what is called a policy loan whenever we want to. So using an example, if you had a $200,000 house and you've been paying into it for 10 years, and let's say you have $100,000 left on the mortgage, that means you have $100,000 in equity or cash value in that policy. A bank, if you were to go to them and say, hey, I want to take out a cash out refinance or a line of credit on my equity on my home, they would give you a percentage of that equity, typically like 80 to 90%. And they'll say, okay, we'll give you a loan for $80,000 for the equity that you have built into that. You can use that equity loan for whatever you would like. The exact same principle is at place with our policy loans as well. So in other words, we have this lump sum that we've been paying into. It's been growing at 4% nice and consistently for us. And if we want to use that money for something, maybe we want to use it as a down payment on another property. Maybe we want to invest in our business. Maybe we want to, grow and purchase a new piece of equipment or take a vacation. Whatever you want to do, there's no restrictions. It's your money. You can actually take out a loan from your money and use that just like you would a cash out refinance or a line of credit. Now, why do we want to do that? Well, we want to do that primarily because we don't want to interrupt the compounding growth on our money, right? If we're getting guaranteed 4% growth year over year over year in that, and we're continuing to add and snowball this money, if we take and withdraw the money out of that account, we lose that growth, right? This is the challenge with compounding growth on something like the stock market accounts or a 401k, right? You have a couple good years, you go up, 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 and then you lose for a couple of years. You lose all of that growth. And it might take a year or two to get back up to where you were, and you take a big drop off in momentum to get back to where you thought you needed to be. And so that drop in compounding interest is extremely problematic. And so we don't want to withdraw our money and lose out on that interest that we're gaining on our money as it goes. We want to keep our capital, our principal, and that growing compounding interest in those accounts so it can keep growing and growing and snowballing. And so the way the policy loans work are just like that equity, like we mentioned. The insurance company will let you lend out amount of money that you set out of your cash value. And what they do is they actually give it out of their general account. So most people go, whoa, I'm paying a loan out on my own money. Well, you're not, because it's not actually withdrawing your money from your policy. This is what allows you to use your money in two places at once. It's technically not your money that you're withdrawing. Just like the bank doesn't really take the equity out of your home to give you that money, they use the equity or the cash value that's in your account as collateral. And so it's the same exact idea. So the insurance company will loan you money based on the volume or the account balance you have. So if you have $100,000 in there, they might give you $95,000 in a loan out, or any percentage of that, whatever you might need. And that amount of money is something that you can use for whatever you might want, whenever you might want. So just in terms of how this gets used, basically you ask for this draw from this loan from your policy, and within 5 to 7 days electronically, or they can mail it to you, you will get a check for that loan right out from the insurance company. No restrictions, no timelines, no paperwork. It is a private contract between you and the insurance company. There's no paper trail. It doesn't go in your credit report. It's a private engagement that happens there. Very advantageous when you're trying to go, and grow your credit and use your money for whatever purposes you would like. So how the loans actually work is because it is a loan, there is interest that the insurance charges you. A couple things to keep in mind. The interest that the insurance company provides you is simple interest, not compounding interest, right? It averages most insurance companies around 4 to 6%, a simple loan interest. So if you took out $100,000, they're charging you $5,000, for example, 5% per year. And that's how it would be each year as you pay it back, not compounding interest where you're paying it on the balance and it's going to grow out of control. So what that means is you're borrowing money at a simple interest rate, but your original principal is growing at a compounding rate. So you see how this really becomes very powerful. You get to loan money out at a low interest rate and let your nest egg continue to grow without interrupting it. One of the other major advantages to these loans is you get to set the terms of the loans however you want. And it's not something you have to decide on right away. And you actually, believe it or not, do not even need to pay the loan back at all if you do not want to during your living years. Now, the way that works is, remember, the loan is what's called self-collateralized. So because you have that $100,000 in your account and you took a loan for $95,000 out, the insurance company still has the original $100,000 in their account. So what they do is they say, look, we're just going to charge you that set 5%, 4 to 6% interest, simple interest year over year if you don't pay us back. So we're just going to keep charging you that as you pay it down, or if you just don't pay it all together. And that's going to keep growing. So if the simple interest continues to grow and you decide, I'm not going to pay this loan back, I don't want to, or maybe you're going to use it as retirement income or whatever, you'll continue to accrue that interest. But the balance of that loan will be deducted from your death benefit when you pass away. So I'm just going to repeat that. The balance of the loan that you took, right? So if I had $100,000 in my policy, I took a loan for $95,000 and I never paid it back for 20 years. And maybe that $95,000 with interest, it swelled to $120,000. So I owe the insurance company $120,000. I've had to make no payments. I just decided I wasn't going to pay it back. and maybe my death benefit was $1 million. So when I die, let's say I'm 85, I pass away, the insurance company is going to take what you owe them, that $120,000 from the loan, right off the top of the death benefit. So they were going to pay out your beneficiary, your spouse, $1 million as the death benefit. They'll just take that loan that you owe them right off the top. So you get paid the $880,000 right from it. So it's pretty simple how that works. Now, of course, if you wanted to pay the loan back quicker, if you wanted to take the loan out, pay it back the next week, the next year, you want to break it out over 20 years, you want to pay $50,000 one week and then wait 6 months, there's no terms or set payback period. You get full control over that. Just know in the background, you're gaining that 5% simple interest on what you're having to pay that loan back. Right? So super, super powerful strategy. And again, going back to this concept of being a warehouse for wealth, not necessarily the end investment. You certainly could use this to grow 4%, guaranteed tax advantages and liquidity and all these different things. And you wanted to use it for retirement income or something else, that's great. But if you wanted to, you could use this account to leverage to use it for other investing. Lots and lots of people that see this and go, you know what? I actually can use the same dollar in two places at once through this strategy, right? So I can loan out my $100,000. I can then take that and buy, let's say, an investment property or put a down payment on a couple of investment properties and then get loans on those properties. So there's just this great exponential growth of being able to leverage your money in two places at once and use it super, super strategically. So any opportunities that come up, any life events, a wedding, a death in the family, a medical emergency, many, many different things happen in our lives. And if we have to wait until we're 59 and a half in a 401k or any of these other types of policies to access our money, we're really hurting ourselves, right? Because it's really painful for us to have to wait until the government says it's okay for us to touch our money. Because as high paid professionals, as entrepreneurs, we don't follow the trends of the average people, right? We want to be able to use our money to make more money. Maybe we're making 4% in our compounding insurance policy, and we can make 12% in a real estate transaction, or we can invest in a stock, or we can invest in a friend's business, or start our own side hustle. Whatever it might be, there's no limit to what you can use. But the beauty here is it allows you to use your dollars in two places at once. Now, we've talked multiple times about how we're going to be continuously funding an account or a policy over multiple years. Maybe it's 20, 30, 40 years. But what if we have a lump sum? Maybe I'm already 65 years old and I have a lump sum, or maybe I've made a couple big commission checks or just sold something large in my business. I have a lump sum of money. Can I still use this strategy? And the answer is 100%. You definitely can. It just has to be structured in the right way because, again, we need to set up that maximum that you're going to put in. And so typically we normally break it into a couple of years. So if you had $250,000, we may break that into 3-year payments or 4-year payments or something like that. And there's a couple different ways we can do it. We can actually put it into a holding account and set this up for you so you can continue to gain that interest. So lump sums are definitely something that you can use. It doesn't have to be something where you have to fund it at a certain level forever. When we actually get on and do consultations with our clients on our initial calls, we're going to go through a comprehensive breakdown of your financial situation, where and what you're looking to achieve out of these accounts. And with that in mind, we're going to set up a policy, design a policy with those end goals in mind. If it's to fund something, if it's just to drop a lump sum in and get the interest off of that, you can have what we call a 2, a 3, a 4 pay, which just means 1 or 2 or 3, 4 years that you're going to fund that account. We can use that in a lump sum as well. That way we can just drop a large amount in, get that access to the cash value. But just like anything else, it does take a little time to get going. So a lot of people ask us, okay, well, this looks really great. I love the advantages here, but what's the catch? And my answer is always, well, it's a get rich slow strategy because you're buying an asset, which means it takes time. You have to purchase that asset and you got to pay down that premium so that you can fund into that cash value. That doesn't mean in the first year you're not going to have cash value. It doesn't mean you're not going to be able to get all the advantages that you get out of an insurance policy. It just means that it takes a little time for that really compounding or exponential growth to happen. So it's a patience game. It takes a couple of years for it to really kick into gear, but you can start taking advantage of it from day one. Lump sums are one of the ways that really help speed up that process as well, of course, as well. Now, You may have walked through all this and said, okay, this looks like something I might be interested in. I've obviously got some questions in a little less than an hour here. We obviously can't go through every single component. This is a very complex topic. Insurance does have a lot of variations to it. So you may be figuring out, all right, well, how do I learn more about kind of what next steps look like? Or if I wanted to get a policy in place, what would that strategy even be? How would I actually get that going? And so what I'm going to walk through here as we round out will be our kind of how you would work with us and how the next steps get in place for actually getting a policy here. So the way that we do this is we have a really simple process. We want to set up an intro call. And on that intro call, the entire purpose is really for us to send you a questionnaire beforehand so that when we get on the call, we're making the most of our time together. We are sort of looking through all of your goals with your financial scenario and what you're trying to achieve out of this insurance. And with that, we'll then begin to start brainstorming some ideas on what a policy would look like, and we're going to make sure it's the right fit for you. Obviously, this policy is not going to be the perfect strategy for everyone, and we want to make sure on that intro call, it's no obligation that you have to sign up or spend any money on anything. It's all about trying to understand your scenario and make a recommendation as to what might be the best fit for you, if any. Once we get that information from you on that first call, we'll then set up a second meeting. Our team's going to go and we're going to put together several different options with several different carriers to give you an idea of what different policy designs look like. So we'll have some where you fund things for 2 or 3 years, 5 years, different amounts, different age groups, all that sort of stuff. So you can see what might be a good fit for you and which one you might want to take advantage of. Once we actually get through and you select a policy design that you think is going to work for you, we'll take your initial application, we'll take the design that we structured together, and we're going to submit this to the insurance company. So remember, this is insurance, therefore there is an underwriting process. And all that means is the insurance company has a division of their company where they need to assess the risk of insuring you. So we're buying life insurance, which means that there is a medical component, there's a financial component, there's a background, and they need to assess all of those things in order to put sort of an insurability level on you and a risk assessment on you. The insurance company will go through that process. Now, they may need to ask you some further questions. There may be more things than the application was able to disclose, and we will help walk you through all that process. The other thing to keep in mind is the medical component. Now, as of the recording of this video, we're in the coronavirus, so everything is in quarantine, so there is not as much emphasis on getting out there and getting medical exams, but there still may be a requirement to do so. That has to do typically with your health rating, your age. The insurance company may require that you have to get a physical exam. And it's essentially just a really simple process we're going to go through. You may need to get blood work as well. And they will just approve or go through a series of physical exams to make sure you're approved for the policy and the pricing that we put in place in the design. So underwriting can take a little bit of time. I would say start to finish, if we were to go from an initial phone call through to actually getting you started and funding your policy, we're looking about 3 to 4 weeks. That's a good estimation about how long this process takes. Once you get approved from the insurer, then we start implementation. And what that means is basically we are going to work with you one-on-one. We'll be your single point of contact moving forward. We'll get your policy in place, show you how to fund it, how to log in onto your portal, how to access and pay into your paid up additions, how to take your loans, whatever you may want. And it's a very, very simple interface with any of our providers to use, but we'll be your resource in case you want to change or alter the policy. Or what ultimately happens is people will go through and find out that they set up that maximum in the beginning and they found out that, they've made a lot more money in the past couple of years and they want to have more money that they can fund into a policy. So unfortunately, we can't add death benefit or add in more of a ceiling for you to pay into. So that is the case where we actually open up a separate insurance policy. We open up another one there. So it's important that we understand that in the beginning. We'll go through all that on the intro call, but we'll be your point of contact in case you want to add to your policy or add another policy at any time. And we'll be, keeping in touch with you every year on your anniversary to make sure everything's going okay. And you'll have full customer, care throughout that process as well. So once we get you live, that's how we'll take things forward. And that will be, to make sure you've got a customer service rep should any questions come up. Now, we also want to let you know about all pricing and costs here as well. So just so you understand, the way that these policies are structured, when we set these up for you, we do not charge you, the customer, the policyholder, anything. There's no fee, there's no brokerage amount, there is no processing that you're going to be paying us for. You're simply going to be paying into your policy at the insurance company. The insurance company in return will pay us as your agent a commission for bringing you on as a customer. So there's no outside fees you have to worry about. We'll still be your point of contact moving forward. We are compensated to make sure that your account stays in action. But going back to how we set up these designed policies, remember, we are shrinking down that premium. So as an agent, we get paid on the premium that we close. And so the reason why a lot of insurance agents will not go forward with one of these type of policies is because they are really cutting down their commissions on one of these premiums. And so with us, we're focused on letting you maximize and use this strategy, this life insurance policy, as a financial tool or in a savings tool. And it just does not work if you take a traditional whole life insurance policy, because it's structured in a way to really help out the agent and not really help out the policyholder during their living years. It's only really helpful for their death benefit. We find that to be not very ethically sound, and we want to make sure that we are giving you the best bang for your buck and using a product that is really engineered for your success. That's why we're able to shrink down those premiums. You're not paying anything to us in a transactional manner. We're your point of contact, but we are compensated on the back end by the insurance companies. So very straightforward model. We find our clients really love to work with us in that way. And so that is kind of the whole view of things. So at this point, you get an idea of kind of how that process works. Even if you're remotely interested in just kind of seeing, hey, I've got some unique things that I do in my business, or I'm a sales professional and I have some quirky commissions and all this kind of stuff. I'm not really sure what this would look like, but highly encourage you to at least book an intro call. Like I mentioned, there's no obligation. We will go through your scenario. We'll make a decision as a team mutually. If we think it's a good fit, we'll show you some suggestions and some solutions, and we'll talk through what might be a good fit for you or not. And so it's very consultative in that way, and we'll make sure not to sell you anything that's not going to be in your best interest. That is our goal. So with all that in mind, I wanted to thank you for sitting through this. Obviously, like we mentioned, in a 1 hour session here, we can only cover so much. With all the complexity, I would highly encourage you to check out our website and our blog, check out our YouTube as well. Look through those videos. If you have further questions, you can email or call us. Our lines are below this video. Otherwise, book that intro call. We can talk through any of those things on a personal level as well. Thanks so much.